Welcome to our lecture series on international financial management. Today, we will talk about the processes involved in international trade finance. International trade and international trade finance are two closely connected systems that enable the global flow of goods, services, and capital. While international trade focuses on the physical and commercial aspects of buying and selling across borders, international trade finance provides the financial infrastructure, instruments, and mechanisms to fund, secure, and settle these transactions. Understanding both is crucial for managing global operations. This video explores international trade and finance processes. International trade unfolds in five main stages: pre-trade planning, execution, financing, customs clearance, and post-trade settlement, involving actors, documents, and financial flows. The first of these processes is the market research and opportunity identification. Exporters and importers begin by researching potential markets and trade partners. This involves analyzing demand, pricing, logistics costs, tariffs, and exchange rates. Companies often use export promotion agencies or trade missions to identify viable opportunities. The second process is the partner selection and due diligence. Firms identify trustworthy suppliers, distributors, or buyers abroad. Due diligence is critical. It includes credit checks, legal background reviews, and verification of authenticity. Trade directories, embassies, and chambers of commerce assist in validating trade partners. The third process is the negotiation of terms and contracts. The exporter and importer negotiate terms of trade such as product specifications, pricing, delivery schedule, and payment terms. They also agree on key elements including currency of trade, payment method, risk-sharing terms, and legal jurisdiction and dispute resolution mechanisms. The fourth process is the selection of international commercial terms. These define the allocation of responsibilities between buyer and seller concerning transport, risk, and cost. Common examples include FOB, CEF, EXW, and DDP, which define buyer-seller responsibilities for transport, risk, and cost. The fifth process is the export licensing and regulatory compliance. Exporters must obtain necessary licenses, ensure product compliance with destination regulations, and adhere to export control laws. Goods are screened for sanctions, embargoes, or dual-use restrictions. Export licensing ensures compliance with laws, sanctions, embargoes, and dual-use restrictions. The sixth process is the production, inspection, and packaging. The exporter manufactures, assembles, and prepares goods for shipment. Independent quality inspections may be conducted by agencies. The seventh process is the transportation and logistics. Exporters coordinate freight forwarding, warehousing, and shipping. This includes arranging marine insurance and selecting a carrier or shipping line. Transportation can be via sea, air, rail, or multimodal systems. The eighth process is the documentation preparation. International trade requires precise documentation to comply with customs and payment requirements. Key documents include commercial invoice, packing list, bill of lading, certificate of origin, insurance certificate, and export-import licenses. The ninth process is the customs clearance. Goods must be declared to customs authorities in both the exporting and importing countries. Duties and taxes are assessed and paid before clearance. Brokers often facilitate this process using digital platforms like the automated export system. The 11th process is the delivery and receipt of goods. Once cleared, goods are delivered according to the agreed international commercial terms. The buyer inspects them upon arrival, and any discrepancies or damages are reported for resolution. The final process is the post-trade activities. After shipment and payment, both parties handle accounting, warranty claims, and reconciliation. Performance analysis helps improve efficiency for future transactions. There are many processes that are specific to the financing of international trade. International trade finance provides the financial structure that underpins global trade. It includes processes that facilitate credit, liquidity, risk mitigation, and settlement of cross-border transactions. The first of the international trade financing process is the credit assessment and risk evaluation. Financial institutions begin by assessing the creditworthiness of both exporter and importer. Risk assessment includes examining financial statements, trade history, collateral, and country risk ratings. The results determine the type of trade finance facility to be extended. The second process is the structuring the financing arrangement. The bank and the client agree on a suitable financing method. Choices include pre-shipment finance, post-shipment finance, documentary credit, or structured trade finance. Legal documents are drawn up to define repayment terms, interest rates, and collateral. The third process of finance is the issuance of financial instruments. Various banking instruments are used to facilitate payment and guarantee performance. These include letters of credit, bank guarantees, documentary collections, and standby letters of credit. The fourth process is the pre-shipment finance. Exporters often require working capital before shipment to purchase raw materials or pay labor. Pre-shipment finance provides funds based on confirmed export orders or letters of credit. The fifth process is the post-shipment finance. After goods are shipped, exporters may face a gap before receiving payment. Post-shipment finance bridges this gap through mechanisms such as bill discounting, export bill negotiation, and forfeiting for long-term receivables. The sixth process is the import financing. Importers may seek financing to pay exporters before receiving or selling the goods. Methods include buyer's credit, supplier's credit, or trust receipt financing. The seventh process of financing is the risk mitigation and insurance. Trade finance involves numerous risks such as non-payment, political instability, or currency volatility. These are managed through instruments like trade credit insurance, political risk insurance, export credit agency guarantees, and hedging with currency forwards and options. The eighth process in financing is the document examination and compliance. Banks verify all trade documents for compliance with the terms of the financial instrument. Any discrepancies can delay or invalidate payment. The ninth process is the payment and settlement. Settlement is carried out through secure international payment systems. Depending on terms, payments can be immediate or deferred. Banks record settlements and exchange rate conversions. The 10th process in financing is the foreign exchange and hedging operations. As international transactions involve multiple currencies, banks and firms manage foreign exchange exposure using derivatives, forward contracts, swaps, or options to lock in rates and reduce volatility. The 11th process is the compliance and anti-money laundering screening. All trade finance transactions undergo sanctions screening, anti-money laundering checks, and know your customer verification. Compliance ensures transactions adhere to international regulations. The final process in financing is the post-trade monitoring and reporting. Banks continuously monitor exposure, client performance, and portfolio concentration. Periodic audits ensure adherence to international banking regulatory capital adequacy standards and international trade regulations. The processes of international trade and trade finance operate as interdependent systems that drive global economic growth. While international trade manages the physical and logistical movement of goods, trade finance provides the liquidity, security, and credit mechanisms necessary to execute and settle transactions securely. Mastery of both processes enables firms and financial institutions to manage cross-border risks efficiently and sustain long-term competitiveness in international markets. Thank you for watching our lecture video on international financial management, focusing on processes involved in international trade finance. See you at the next lecture.